Welcome to This Explainer. Today, we're diving into a stock that's honestly been taking investors on an absolute roller coaster ride lately, Netflix. We're going to look under the hood at its current market position, unpack the fundamental drivers of its business, and explore the dramatic shifts we've seen in its valuation. Whether you're actively investing or just fascinated by the economics of the streaming wars, you are definitely in the right place. Let's kick things off with arguably the most staggering number out there right now, 40%. That is exactly how much Netflix stock has plummeted from its June 2025 peak, settling in right around $77 to $78 a share. And when you factor in that it's down roughly 17% year to date, well, it brings us to the ultimate question every single investor's asking themselves. Is this the perfect time to scoop up a world-class company at a discount? Or is this a flashing red warning sign of deeper trouble ahead? To figure that out, we're going to walk through the valuation reset, the bull case, the bear case, valuation in the numbers, and then wrap it all up with our final verdict. So, part 1, the valuation reset. Let's look at the current state of NFLX stock. This reset in valuation is just undeniable. We're talking about a really steep decline from those mid-2025 highs, which has completely reset expectations across Wall Street. With the stock currently hovering in that $77 to $78 range, this isn't just some minor dip. It is a fundamental repricing by the market. Moving on to part 2, the bull case, let's talk about why investors are getting excited. You really can't talk about the bull case without bringing up billionaire investor Bill Ackman. Through Pershing Square, he just built a massive 3.15 million share stake in the company. And remember, he actually sold Netflix at a steep loss back in 2022, so for him to jump back in with this kind of size, that's a major statement. His core argument is that Netflix has, in his own words, effectively won the streaming wars. And with 325 million global paid subscribers, which by the way is nearly double its closest rival, their scale is just completely unmatched. And honestly, the fundamentals totally back up Ackman's confidence. Just look at the margin expansion. Gross margins are climbing incredibly fast, going from roughly 39% back in 2020 to an anticipated 52% by 2026. Operating margins are also looking really strong at 33.4%, which is up from a year ago. It just proves that Netflix isn't merely growing, they're getting significantly more profitable as they do it. Looking ahead, management is projecting some stellar 2026 revenues of around $51 billion. That's a very healthy 13 to 14% growth rate. They're also being super aggressive about returning capital to shareholders. In Q2 alone, they executed a massive $4.7 billion stock buyback. They're basically betting on themselves by pulling shares off the market. Plus, they've got this huge new growth engine, advertising revenue, which is projected to double to $3 billion. And here's something that brilliantly illustrates their long-term potential. According to CFO Spence Neumann, Netflix has actually penetrated less than 45% of the 800 million addressable households globally. On top of that, they account for only about 5% of global television viewing time. That signals a massive, massive runway for international growth, especially in markets like Latin America and Asia Pacific, where they recently saw 21% and 16% revenue growth, respectively. All right, let's flip the coin. Part 3, the bear case. Here is why investors are worried. First and foremost, growth is visibly moderating. Management guided for just 11.7% revenue growth in Q3, which actually came in below Wall Street's expectations. They're also facing some really tough year-over-year comparisons in the second half of 2025, mostly because last year they had massive hits like Stranger Things and Squid Game padding the numbers. But here's the absolute biggest concern. There's growing unease that these recent revenue boosts are coming from aggressive price hikes, not organic subscriber growth. They've pushed through 3 price hikes in under 3 years, including a 12.5% jump just on their ad-supported tier. Which brings us to the competitive landscape. It is intensifying dramatically. Think about Amazon leaning heavily into Prime Video. Amazon has a genuinely terrifying advantage here. Their video service is bundled with free shipping, which keeps consumers way less cost-conscious than they are with a standalone, pure-play subscription like Netflix. Not to mention, Amazon already has a deeply established advertising tech infrastructure. At the exact same time, content costs are surging. Netflix plans to bump up content spending by about 10% in 2026. Because of this elevated investment, free cash flow, the actual cash left in the bank after paying the bills, is projected to drop pretty significantly from $9.5 billion in 2025 down to about $6 billion in 2026. And hey, remember that massive stock buyback we just talked about? Well, it's currently on pause. They've had to halt those buybacks to preserve cash for a massive impending acquisition of Warner Brothers Studios and HBO. Then there's this final, somewhat subtle shift to consider. Starting in 2027, Netflix is going to start reporting its engagement data annually instead of semi-annually. Now, the company insists viewing hours are up, but let's be real. Less frequent reporting almost always sparks speculation on Wall Street that underlying momentum might be slowing down, and management just wants to control the narrative. So, let's look at part 4, valuation and the numbers. What the data actually tells us. Crunching the numbers, the stock trades at roughly a 21 times forward price to earnings ratio, meaning investors are paying $21 for every expected dollar of future profit. It's also trading at about 6.7 times sales. If you look at the 51 analysts polled by S&P Global, the average price target sits right around $94 to $95. Based on current levels, that's a solid 21% upside. You've got bulls like BMO Capital seeing a high target of $135, which is a massive 73% upside, while more conservative estimates from folks like JP Morgan sit closer to the $70 low target range. That 21x forward PE is definitely below Netflix's historical premiums, but it's still notably higher than legacy competitors like Disney. Now, the absolute most critical catalyst to justify those higher targets is the advertising tier. Currently, the ad-supported tier accounts for over 60% of new signups in eligible markets. Analysts are projecting this revenue is going to scale aggressively, from $1.5 billion in 2025 to $4.5 billion in 2027, all the way to a staggering $9.5 billion by 2030. That is high-margin revenue that could completely transform their entire profitability profile. All right, that brings us to part 5, the final verdict, the investment decision. We really have to weigh two very compelling realities against each other here. On one hand, Netflix is the undisputed high-margin streaming leader with 325 million subs, armed with multiple growth engines like ads, gaming, and live events. On the other hand, we have the undeniable facts of moderating growth, intense competition from cash-rich tech giants who don't even need streaming to be their primary profit center, and massive impending content costs from acquisitions and ongoing production. So what's the bottom line? Well, Netflix remains an incredibly high-quality, highly profitable business trading at a reasonable valuation. But make no mistake, it is not a deep bargain. A 20 to 21 times forward PE is fair for a company generating 13% revenue growth with expanding margins. Going forward, you've got to keep a close eye on 3 things: advertising revenue growth, underlying engagement trends, and how that second half 2026 content slate actually performs. And above all, be fully prepared for near-term volatility. For sure, this is not a stock for the faint of heart. As the entire streaming industry aggressively shifts away from subscriber acquisition at all costs and towards pure monetization and profitability, we want to leave you with one final thought. Taking into account everything we've covered today, the changing landscape and this evolving business model, has Netflix truly won the streaming war, or did they just win the first battle? Think about it. Thanks so much for joining us for this explainer, and we'll see you next time.